All right, so now we want to talk about loss contingencies. So let me get started here. Find it. Here we go. All right. So what is a loss contingency? Well, it's an existing uncertain situation involving a potential loss depending on some future event. And so the question is, well, do we accrue the loss contingency or not? Well, uh, whether a loss contingency is accrued in the financial statements depends on two things. Number one, the likelihood that the confirming event will occur, and whether or not it can be determined the amount of the loss. And so if the likelihood that the confirming event will occur is probable and also estimable, then it must be accrued. So let's look at the first one. You've got three categories of likelihood that the confirming event will occur. Uh, Probable, reasonably possible, and remote. And so it seems a little difficult to, try to figure out which category an event that's occurred, it's an existing uncertain situation, so that the event uh, that gives lie to the loss contingency has already occurred, and the amount of potential loss depends on some future event. And so the most obvious situation is someone, a party who has sued you um, in a cause of action against you, and the cause of action is still pending. It hasn't been resolved either by settlement or between the parties or some sort of jury trial. Again, it's kind of hard to fit these past events into these three categories. Seems like there is not as much room between probable and reasonably possible as there is between reasonably possible and remote. But those are the categories we're given, so somehow you've got to fit the situation that's at hand into these particular categories of likelihood that the confirming event will occur. So probable is that the event is likely to occur. Reasonably possible means that the chance the event will occur is more than remote, but less than likely. And then remote is the chance that this will occur is slight. So probably you would look at that as there's a greater than, a greater than 50% chance that the event will occur, if you want to put some percentages to it. Reasonably possible, uh, geez, who knows? It could be anywhere between 20% and 50% chance. Not sure. And then remote, probably less than 20% chance. But again, I'm just putting some calculations in there on those last two because who knows what the answer really is. They don't give you much guidance. All right, so here's one of our questions here. Which of the following is not true regarding loss contingencies and their disclosure? Let's see. A loss contingency arises when there's uncertainty about whether a past event will result in future loss. That's true. US GAAP requires the likelihood of the future event be categorized as probable, reasonably possible, or remote. True. Companies are required to account for a loss contingency when the event that gave rise to it occurred before the end of the fiscal year. Companies are required to account for a loss contingency when the event that gave rise to it occurred before the end of the fiscal year. No, that's not totally true. I mean, it could be if it's probable and reasonably estimable, but just the fact that it occurs before the end of the year doesn't mean that you're required to account for it as a loss contingency. So I think it's C. It's kind of a difficult one. Okay. So anyway, here are your three categories of likelihood, and it's set against the backdrop of the dollar amount of potential loss possibilities, which are known, reasonably estimable, or not reasonably estimable. Of course, if it's known and it's probable that there's a likelihood the event will occur, the loss contingency must be accounted for as a liability in the income statements and, well, in the financial statements, I should say, and also disclosed in the notes to the financial statements. If it's probable and still reasonably estimable, the amount of the loss contingency, that is, then it also has to be accrued in the financial statements and disclosed in a note to the financial statements. If it's probable but not reasonably estimable, then it simply is disclosed in the notes to the financial statements. If it's reasonably possible and known the amount of potential loss, then because it's only reasonably possible that this might occur in the future, this liability, then you disclose in a note only. If it's reasonably estimable, disclose as well. If it's not reasonably estimable, disclose as well. And if it's remote, whether it's known, reasonably estimable, or not reasonably estimable, no disclosure is required. And so you debit a loss or an expense account, such as when it's a warranty expense or something like that, and credit a liability because you're going to pay it in the future. If a loss contingency is resolved using a non-cash asset, or as you've seen with accounts receivable and the allowance for doubtful accounts account, which is a valuation account, you credit the asset or the valuation account. All right, product warranties and guarantees. Most consumer products come with some sort of guarantee when they purchase the product, and it's a quality assurance warranty. So it's assuring that the product will work as promised or as advertised. And so the cost of satisfying these guarantees should be estimable, and they should be recorded as expenses in the same accounting period the products are sold. So this is a loss contingency. So the criteria for accruing a contingent loss for warranties of this type are almost always met. So you should, from past experience, be able to estimate the amount of product warranties in a particular period. And because of this, it's both probable as well as reasonably estimable. So for that reason, you must record a loss or a liability for the amount of the estimated loss. So here we have an example of a supplier in home health care products. They introduced a new therapeutic chair carrying a 2-year warranty against defects. They estimate, based on industry experience, warranty costs of 3% of sales during the first 12 months following the sale, and 4% the following 12 months. During December 2018, its first month of availability, they sold $2 million in chairs, and so they're going to book 7% of that. There's your original entry for recognizing the receive the $2 million. Of course, it's probably not in one lump sum, but you get the idea. And then you're simply going to credit warranty expense for 7% of the $2 million in sales for the month of December, and record it as a credit, a liability, warranty liability. Now, if and when a customer makes a claim, you're simply going to debit whatever expense, whether it be wage expense for the cost of workers working on satisfying the warranty through labor or parts or whatever. So that would be your credit parts and supplies, labor, etc. And then you simply debit that portion of the estimated warranty liability that is used up. Now, if you have a situation where a warranty is used over more than one period, you have to use this expected cash flow approach. And so here we ignore the time value of money, the traditional way that we just saw, but the expected cash flow approach, which I think we've looked at before, incorporates not only probabilities of cash flows, but also incorporates time value of money principles as well. And so again, you use this expected cash flow approach when the warranty obligation spans more than 1 year, and we can associate probabilities with possible cash flow outcomes. So kind of the same example we just saw, and here we have the 2-year warranty. So they're expecting in 2019 the possibility or the probability of outgoing cash flows due to warranty costs between $50,000 and $70,000. $50,000, the probability is 20%, 60 is 50%, and 70 is 30%. And then in 2020, we have the probability of cash outflows due to warranties of 70%, or excuse me, $70,000 at 20%, $80,000 at 50%, and $90,000 at 30%. So you simply multiply, for instance, the 50,000 times 20% to come up with 10,000, the 60,000 times 50% to come up with 30,000, and 70,000 times 30% to come up with 21,000. And you add those up, and you do the same for 2020, and then you take and figure out the present value of each year based upon those sums. And so here's an example of that. So like 2019, you see the sum is of the probabilities times the amounts is $61,000, and you take and multiply it times 1 year, well, times 5% at 1 year. If you look at your present value tables, that's 0.95238. So if you look at table 2, present value of $1 under 5%, 1 period is 0.95238. So that's where they got that. So you multiply the 61,000 times the 0.95238 to come up with 58,095, and then for 2020 you've got 81,000 as the amount, and you multiply this times 0.90703, looking at the same table, that's in year 2 at 5%. So that gets you 73,469. You take that and add to the 58,095, and you come up with a total of 131,564. So that would be your estimated warranty liability. Now, extended warranties are something much different than the product warranty, because these are offered at the time of the purchase to customers, and it's up to the customer to decide whether or not they want to purchase this extended warranty. And so it goes beyond the original manufacturer's warranty, and it's priced and sold separately. And if you recall, it's a separate performance obligation, and so because of that, it is very possible that revenue will be recognized in a different period than when the product's sold, because the obligation may not be met in order to recognize revenue until a later period. So here, what we do is we recognize revenue over the contract period. So let's say if you've got a 3-year extended warranty, you're going to recognize revenue on a straight line basis over that 3-year period. And so, for example, we have this brand name appliances. Its major appliances carry a 1-year manufacturer's warranty, and they also are offered to customers the ability to purchase a 3-year extended warranty for an additional charge. On January 3rd, 2018, brand name sold a $60 extended warranty covering years 2019 through 21, and so they're going to recognize this as a liability, warranty liability up front, or at least as deferred revenue, warranty revenue, and then over the life of this 3 years, they're going to recognize revenues of $20 each year. So here's the original entry, deferred revenue, extended warranties, and then they're going to back out the deferred revenue each year for $20 and recognize revenue of $20. Lawsuits, litigation is a big part of contingencies for companies. So accruing a loss on pending litigation is very rare for several reasons. Number one, the outcome of litigation is highly uncertain. Number two, the loss is usually not recorded until after the ultimate settlement. If you can imagine, jury trials are very, very unpredictable. And so you never know what's going to happen. So even if you think that it's probable that something will occur that causes you to incur a loss, such as you believe it's probable that a jury will find in the plaintiff's favor, not your favor, and even if the amount's reasonably estimable, you're not going to book a liability, because again, you never know what's going to happen in a jury trial. Not only that, but as the book points out, if you put this in your financial statements and it's published, then the defense is going, or excuse me, the plaintiff is going to use that information against you, probably for their own advantage. You should always provide extensive disclosure, although some companies do not always do so. So here's an example of such a disclosure. Notice it's kind of general, as are most of these, not really discussing particular cases. And even if a firm gets a verdict against them, you can always, at least up to the highest court possible, appeal. So even if you have a judgment or a verdict in a lower court that's decided against you, if you have the ability to appeal, you don't necessarily have to book a liability in your financial statements. So here's an example of that. Now understand again that the cause of a loss contingency must occur before the end of the fiscal year. And so, you know, to even note something, have the possibility of booking a liability in your financial statements, it's got to occur before the end of the fiscal year. However, the event that clarifies the loss contingency may not occur until after the end of the fiscal year. If it occurs after the end of the fiscal year, this clarifying event, such as a verdict against you, and it's before the financial statements are either available for publishing or actually published, then it must be included as an accrual of a liability. So you see that situation going on here. And here's a note to that effect. So in this case, we had a lawsuit that existed at the end of the year, and then there was a verdict against the defendant, and I suppose this is Starbucks financial statements. So Starbucks was ordered to pay Kraft $2.2 billion plus in damages, prejudgment interest, and attorney's fees. And so here, what they've done is they've estimated prejudgment interest and attorney's fees, and so they recorded a litigation charge of $2.7 billion in their 2013 operating results, because there was a clarification after the fiscal year, and the cause of the loss contingency, the lawsuit, occurred before the end of the fiscal year. Now, if the cause of the loss contingency occurs after the fiscal year ends, you certainly don't accrue a liability, but certainly you're going to provide a description in the notes to the financial statements. Now, this is a situation where this could occur before or after the clarification could come before or after the financial statements are published. So it says if the failure to disclose the possible loss would cause the financial statements to be misleading, the situation should be described in the disclosure note, including the effect of possible loss on key accounting numbers affected. So any event occurring after the fiscal year, but before financial statement are issued that has a material effect on the company's financial position must be disclosed in a subsequent events disclosure note. And so examples would be issuance of a debt or equity securities, a business combination, or discontinued operations. So you see situation here. In February 2016, additional territories in North America met the criteria to be classified as held for sale. Therefore, we're required to record the related assets and liabilities at the lower carrying value or fair value less any cost to sell based on the estimated sales price, which will result in a non-cash loss of $296 million in 2016. So this would be in this company's 2015 notes to the financial statement. Now, what happens if you have unasserted claims? If a claim's yet to be made when the financial statements are issued, it still may require an accrual or disclosure. And so you have to go through a two-step process to determine which it is, if any. And so you have to ask yourself, is it probable that the claim will be asserted? If the answer is yes, then you go to step 2. If the answer is no, then you just stop. And so if the answer to that first question is yes, it is probable that the claim will be asserted, then you go to 2, and you must treat the claim as if the claim has been asserted. And so, again, just like any other situation where a claim has been asserted, you have to go through that two-step process of determining the likelihood of an unfavorable outcome and whether a dollar amount can be estimated. Okay, so ask yourself, will a claim be asserted? Is it probable that it will? If the answer is no, don't do anything. If the answer is it is probable that a claim will be asserted, then you have to ask yourself, is it probable that there will be an unfavorable outcome, and is it at least reasonably estimable the amount of the loss. And if you can, if the answer to those questions are yes, then you've got to report liability. Because of the conservatism principle involved in accrual accounting, let's say you're the plaintiff in a lawsuit and you think it's a probable that you're going to win that lawsuit, and it's at least reasonably estimable the amount that you will win in the lawsuit. Do you record a gain? And the answer is no, because of the conservatism principle. So we record uncertain losses, but not uncertain gains. You do disclose material gain contingencies in the notes to the financial statement, though. All right, so here we have another concept check. On October 1, 2018, this company sold a $480 snowblower with a $120 extended warranty. The warranty covers 3 years of repairs. During 2018, Mazur would recognize warranty revenue of what? Well, let's see. You've got three months here in 2018 accrued, so you've got 1/4 of a year, and it's a 36-month warranty. So basically, you just three months out of 36 months is what, 1/12. So you would take 1/12 of $120, so that would be $10, right? Another one, GK has the following outstanding litigation claims against it. A claim of $100,000. GK thinks it's probable it will lose the claim and estimates the loss at $75,000 if it occurs. A claim of $50,000. GK thinks it's probable it will lose the claim but cannot estimate the amount of loss. And a claim of $10,000. GK thinks it's reasonably possible it will lose the claim and estimates the loss at $8,000 if it occurs. So here, what is the answer? Well, definitely we have the first one. It's probable that they'll lose, and they estimate the loss to be $75,000. So that's definitely included as a liability. The question in number 2, that's definitely not a liability. The question is number 3, and here it's not probable, but it's only reasonably possible. And even if you can estimate the amount of loss, if it's only reasonably possible, you don't have to accrue a liability there. You only have to include a disclosure note. So here the answer is $75,000. Portland's Best Coffee has a litigation claim of $100,000 against it. As of 12/31/2018, Portland considered it probable that it would lose $75,000 on the claim after 2018 year end, but before issuance of the financial statements, Portland settled the litigation for $60,000. How much of a litigation liability should Portland show in its 12/31/2018 financial statements? Let's see. Has a litigation claim of $100,000 against it. As of 12/31/2018, considered it probable that it would lose $75,000 on the claim. After 2018 year end, but before issuance of the financial statement, they settled the litigation. How much of a litigation liability should Portland show on its financial statements? Well, it's C, not D, as it says here. Obviously, it says to the right, the answer C. So, because they settled this before the statements were issued, but after the fiscal year end, they've got to include the liability. All right, so that's it for chapter 13.